And good morning once again. Welcome back, options traders. Well, a problem that I see among a lot of traders is that they don't understand the connections among all of the Greeks. If you listen to most traders, they are always focused on delta, even though they might not use that term. And you can hear it in their conversations. They'll say, well, what do you think the stock's going to do? Do you think it's going up or down? Well, that's a delta question. And if that's all you're going to pursue, might as well take the shares of stock. It's pure delta. But if you're going to use options, you need to understand how all of the Greeks connect. So strategies work best when all the Greeks are considered and created in line with your goals. So what's the gamma, vega, and theta trade-off? Well, let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start with the options trade-offs. If you have a long option, whether a call or a put, which means you bought it, you are going to have negative theta. And that means you are going to lose if the stock stays still, but you are going to profit if the stock moves, at least sufficiently enough to get you past the break-even points. And when this happens, you are going to have a risk graph that looks like a smile. The current curve is going to have this upward kind of sloping graph, going to look a little bit like a smile. And again, that comes from buying an option. You are going to have negative theta. Now, if you also buy an option, you've got negative theta, you are going to have positive gamma. And with positive gamma, again, you are going to profit if the stock moves. But you're going to lose if it stays still. So you can see that there's a connection. Negative theta corresponds to positive gamma. And again, the risk graph looks like a smile. And that's because it is a long option. Now, if you have positive gamma and negative theta, you are also going to have positive vega. Again, you're buying an option, and that means you will profit if volatility rises. So the volatility moves from, let's say, 20% volatility to 21% or 25%. That's an increase in volatility, and that's going to help all options, calls, and puts. But, of course, if you're on the opposite side, you're going to lose if volatility falls. And with positive vega, your risk graph looks like a smile. So notice the connection just among these three. Theta is negative for a long position, that's why it's in red, but gamma and vega are in green. Gamma and vega are joined at the hip. If you have positive gamma, you're going to have positive vega. If you have positive vega, you're going to have positive gamma. And of course, theta will just be on the opposite side. So if you are one of these traders that thinks positive theta is the answer to options trading and you're selling options, yes, you will have positive theta. And there can be some benefits to that. But the thing that traders overlook is you are going to have negative gamma and negative vega. And what are the repercussions of those? That's what you've got to figure out before you step into the position. Now, these relationships that we've just laid out here, that this assumes the same expirations. We're going to find out, like all strategies, there are ways that we can tweak these to where they're not necessarily true. But most of the time, especially for traders who are starting out, you're either long a call or a put, or long a vertical spread, short a vertical spread, and you're always dealing with the same expirations. And if that's true, then those relationships will always hold. Positive gamma equals positive vega, and that's going to be paired with negative theta. So let's look at an example. Let's say if you have the $100 call. So in black is our risk graph at expiration. There is the bend we always get at a strike. So we can see that's lined up at 100. That's the 100 call. But here in blue is the current curve. And again, notice it looks a little bit like a smile. And that's just showing us our profits or losses today. But as time passes, this blue line is going to slowly start to sink down towards the black. So maybe with just a couple of days left, we might be on this green line. So the point to see is that that risk graph, that current curve, these colored curves right here, are going to sink lower. And when that expiration bell rings, then and only then are you on the black curve. That's why it's called the expiration graph. But take a look at this point where the black curve crosses our zero line. Remember, zero means zero profits and losses. And so right there, we need the stock to be above that by expiration to be profitable. So we have this little range in here where even if the stock moves, but it doesn't move fast enough, we could end up with losses. And that's going to be characteristic of a positive gamma position. We need it to get legs and get up and move in order to be profitable. And of course, if it doesn't move, or at least fast enough, then we're going to get hit with negative theta. All right, so that's a look at a positive gamma position. Puts will be exactly the same, just in the opposite direction. Now, what about the trader on the opposite side of this trade? This is taking the long position. What about the short call? Well, it'll be just the opposite. That trader is going to have positive theta. Yes, that's true, but the trader is going to have negative gamma and, of course, negative vega. And the negative gamma is going to show up as a frown. So if you look at that blue curve, kind of sloping downwards towards the bottom of the graph here, looks a little bit like a frown. Unlike the last example that we saw, over time, that blue curve is going to move up. Remember that the current curves, these in colors right here, move towards the black line. So it's going to always appreciate over time. And again, this is where traders make mistakes. They think, hey, since we know that time is passing, you might as well be short options, and that way you're guaranteed to make money. Well, that is absolutely not true, because you have negative gamma and negative vega. So yes, it's true if the stock stays still, or at least partly true, it has to stay still within a range. So we can see that yes, you can make money as long as it stays to this break-even point from the strike right here. We can afford to have it go against us a little bit in this green range right here. We can still be profitable. Of course, we're profitable for any place to the left. All stock prices down here. But we can afford to have it go against us, have it move up, but only in a small range. So again, the idea is that we need the stock to stay relatively quiet. We're not looking for it to make a big move. So there you can see that this frown, kind of this downward curve of the current curve, is from negative gamma, negative vega, and positive theta. And it's going to look like that, kind of a frown shape. All right, let's take a look at a butterfly spread. Now a butterfly spread, notice, kind of has this frown shape here in green, right? The black curve is the expiration graph, the colored curve is the current curve. And you can see it looks a little bit like a frown. So what do you know right off the bat? We have negative gamma, negative vega. Remember, gamma and vega are joined at the hip. If you have negative gamma, you've got negative vega, assuming the same expirations, and we have positive theta. We're going to appreciate over time with this strategy because we can see that everything above zero lies in this little upside down V portion. We need the stock to stay in a relatively quiet range to be profitable. And so over time, our current curve might move from the green to the red, to the blue, to the gray. Look at that. It just keeps moving higher, provided that the stock stays here. So you can see that, look at how pronounced that frown is up here. That's getting some very sharp negative gamma, and you've got to be very careful with things like butterfly spreads for this very reason. Because you might take 2 or 3 or 4 weeks to get your profitability up to here. And because of that sharp curvature, you get a fairly small move in the stock, and look what happens. Suddenly you're in losses because you're out here now in the wings. And we can see that these colored graphs are now moving below zero. All right, so in order to be profitable, we need it to stay in a relatively small range. That's going to be true for positive theta, but what does it mean? We absolutely must have negative gamma and negative vega. Volatility rises, it's going to go against us. If the stock price goes up or down, that's going to go against us. Those are some of the trade-offs with having positive theta. Now, as I mentioned, all of these connections that we just talked about, if you have negative theta and you've got positive gamma and positive vega, that's true if you have the same expirations. Well, again, like a lot of strategies, we can change this. We can actually have different expirations. So let's say, for example, for a calendar spread. Now, a calendar spread, you're going to buy a longer dated call at one strike, and you are going to sell a shorter dated call at the same strike. So, for example, maybe you buy a March 100 call and sell a January 100 call. We're buying March, we're selling January, we've got the same strikes. This will always be a net debit because remember our pricing principles. If we have the same strikes, If you are buying more time, you're buying the longer dated option, it's going to cost you more money. Now, in this case, we have negative gamma, which most people who trade calendar spreads know that we want it to sit still, but we have positive Vega. A little bit ago, I said that gamma and Vega were joined at the hip, that they're connected, but that's assuming that we have the same expirations. Notice that we have different expirations here, so this connection is no longer going to be true. So see, depending on what you're trying to accomplish, you need to make sure that all of these line up in your favor, not just delta, not just theta. So if we have a calendar spread, we look like this, kind of this upside down V, and the current curve might be right here in red, and over time, that red curve moves towards the black, and of course out here in the wings, it's going to move down towards your maximum loss. So the thing to remember is this gamma theta vega trade-off. Don't get hung up on having positive theta. Everybody talks about having positive theta as if that's some kind of a key to success. It just isn't. Because anytime you have positive theta, you will be paired with negative gamma and negative vega. So if you profit from the passing of time, you are going to lose from the movement of the stock or from increasing volatility. So the thing to know is that you must understand the gamma, theta, vega trade-off. They are all part of your strategy, not just delta and not just theta. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.